All right, welcome to The Explainer. Today, we are diving into the two main flavors of stock, common and preferred. Now, you might think stock is stock, right? Well, not exactly. They both give you a piece of a company, but trust me, the power and the perks you get are totally different. So let's just jump right in.
So let's kick things off with a real-world puzzle. Have you ever noticed that Google has two main ticker symbols? You've got Goog and Google Owl. What's the deal with that? Well, a share of Google Owl gives you a vote in how the company is run. A share of Goog, it gives you, well, no vote. And that little difference right there, it's the perfect way to set the stage for what we're talking about today. The huge trade-offs and rights that come with different kinds of stock.
You know, at the end of the day, owning a stock is pretty simple. It's more than just a ticker on a screen. You literally own a slice of the business. I love the pizza analogy here. Think of a company as a giant pizza. Every share is one slice, and it gives you a claim on the company's value and any profits they dish out. But as you're about to find out, not all slices are cut the same.
First up, let's meet the classic, common stock. This is the engine of growth and control.
So what does it actually mean to be a common stockholder? It really boils down to this key phrase, residual ownership. Sounds a little technical, right? All it means is that you're an owner, for sure, but you're kind of at the back of the line. If the company ever had to shut its doors and sell everything, you get what's left over, the residue, but only after everyone else gets paid first.
And that brings us to the fundamental deal you make when you buy common stock. On one hand, you're taking on that risk of being last in line, but in return, you get two potentially massive upsides. First, you get control. You usually get to vote on big company decisions, like who sits on the board. And second, the reward. Your growth potential is basically unlimited. If that company skyrockets, so does the value of your shares.
But here's the thing about that awesome growth potential. With great power comes great volatility. It's just the nature of the beast. The price of common stock can swing like crazy based on an earnings report, a bit of market news, or even just what investors are feeling that day. That direct link to the company's performance is what creates the chance for huge gains. But man, it can make for a bumpy ride.
Okay, let's switch gears and meet our second player, preferred stock. Now, this one's really interesting. I think of it as a true hybrid. It's technically a stock, so it's ownership, but in a lot of ways, it acts more like a bond.
The name really gives it away, right? Preferred stock gets preferred treatment. What does that mean? Well, holders get to jump to the front of the line when it's time for dividends to be paid out. And if the company liquidates, they get their money back before the common stockholders do. Now, for that privilege, they usually give up their voting rights and accept a fixed, predictable dividend.
So when you boil it all down, preferred stock is all about two things, income and stability. It's really designed to be like a steady paycheck for an investor. That fixed dividend gives you a predictable return you can count on, and being first in line for payments is a great safety net. And what's the price you pay for all that security? You usually don't get a vote. No voice, no say in how things are run.
Now hold on. Not all preferred stock is created equal. One of the absolute most important things you need to look for is whether it's cumulative or non-cumulative. If it's cumulative and the company has a tough quarter and has to skip a dividend payment, they still owe you that money. They have to pay you back all the missed dividends before the common shareholders can get a single penny. But with non-cumulative shares, if they skip a payment, it's just gone. Poof, forever. That's a huge difference in security.
Okay. But some preferred stocks have this other really cool feature. You could almost call it a superpower, convertibility. This gives you the option to trade in your preferred shares for a certain number of common shares. It's kind of like getting the best of both worlds. You get to enjoy that steady, stable income, but you also have a ticket to tap into that massive growth potential of the common stock if the company really takes off.
Okay, so we've met the players. Now let's put them in the ring, side by side, for a head-to-head showdown.
So let's just break it down at a glance. Voting rights, usually yes for common, no for preferred. Dividends, for common stock, they're variable, if you get them at all. For preferred, they're fixed and you have priority. What about risk? Well, it's way higher for common stock and lower for preferred. And that brings us to growth potential. It's sky high for common, but pretty limited for preferred, unless, of course, you have those convertible shares we just talked about.
And to really hammer home that idea of risk, you have to understand the pecking order in a crisis. If a company goes belly up, who gets paid first? Number one, it's the lenders and the bondholders. After they get their money, then come the preferred stockholders. And who's at the very, very back of the line just hoping there's something left? You guessed it, the common stockholders.
So you might be wondering, why do these two different types of stock even exist? Well, it's because they're built for completely different investors with totally different goals. Let's take a look at who's buying what and why it makes perfect sense for their strategy.
On one side of the coin, you have the growth seeker. This is someone who is totally comfortable with more risk. They're playing the long game, and what they really want is for their investment to grow in value over time. That is a textbook match for common stock. And then, on the other side, you've got the income hunter. Their priority is a stable, predictable stream of cash. This is often retirees or big institutions who need that reliability. For them, preferred stock is the perfect fit.
But here's a really important point. It's not always an either-or choice. In fact, the smartest, most well-diversified portfolios often use both. Think about it. You can use preferred stock to build a stable income foundation, while your common stock is the engine that drives your long-term growth. It's all about creating that perfect balance.
So it really all comes down to this one simple question. The next time you're thinking about investing, just ask yourself this. Am I paying for growth and a voice, or am I paying for income and stability? If you can answer that, you'll know exactly which type of stock is the right tool for the job.